Hi, Jun. I wanted to address the question that you had regarding allocations on the vertical call spread for the UVXY and whether or not the probability distribution function is normal. First, let's go to the actual strategy. Here we're going out 349 days. So when we're doing that, the probabilities no longer look normal. We have a probability of 50% profit at 57%. The maximum we can make is $67. The most we can lose is $33. And this is on a single contract spread where we buy a $5 call and sell a $6 call, both expiring at exactly the same time, January 21st, 349 days from now. It's a net debit of $33, so it's a defined risk trade. The most you can lose is $33 on a single contract. Of course, you can scale this up as large as you like. The question of how far you should scale it up is answered by, well, perhaps the Kelly criteria. Since we know it's a defined risk, we know how much we're going to lose if we lose, how much we're going to win if we win, and the probability of 50% profit, which is 57% according to the probability distribution function for which we are presented, we can assume that if we do this enough times and we use the law of large numbers, the probability will hopefully be correct. Using the assumption that the probability is correct, we can plug the probability of a win in here. The complementary probability must be the probability of a loss, 1 minus 0.57. The amount we can win, 67. The amount we can lose, 33. The expected return based on only the probability of a win with the amount you can win minus the probability of a loss with the amount you can lose is about $24. That's the expected return, assuming you can win and get 100% of 67 and lose and get 100% of 33. If we're just using 50% profit, maybe the 24 is cut in half to $12 per contract. Kelly criteria comes in this way. Kelly criteria says we know the amount we can win divided by the amount we can lose. We add 1 and multiply by the probability of a win, subtract 1, and then multiply again by the ratio of the loss to the win. Once we do that, we get an estimate for how much we should put into the system, and it's a number that ranges from 0 to 1. And we can multiply that by however much we want to allocate from our portfolio. So if you say you want to allocate no more than $1,000 per trade, you could say, I'll put in $358 into the deal. So if you look at it that way, since the most you can lose is $33 on a single contract, you can scale this up. Assuming you have $1,000 you want to gamble or bet on this on the deal. So you scale it up by, oops, I changed the wrong parameter. You scale it up by increasing quantity. And you do that by going plus, plus, plus until you reach the amount that you're willing to lose. According to Kelly criteria, let's get up to about $330. So now we've got 330 versus 67. It's the same general ratio, 33 to 67, but we bought more contracts. So we bought 10 contracts and we scaled everything up by 10. Naturally, the expected return will increase by an order of magnitude 2. Having done that, the basic question which you asked is, how do I know what the probability distribution function is for UVXY, which is really critical? Well, when you go and you look at the trade for UVXY, it shows it right in through here. And when you look at this long tail, right, that's very consistent with what we know about UVXY because UVXY can get very high. And so what happens now is it's trading at around 10. We're doing a spread between 5 and 10 and 6. Our probability is actually very good that somewhere we'll be able to trade at a premium because this will be way above 10. And in principle, you can shove this around a little bit and change the parameters of the deal. Make it look as though you have a larger spread or a bigger investment, whatever you like, and watch how the probabilities change. Here it's a 50% probability. The amount you can lose is changed quite a bit, and you can scale down the the amount you want to put in, so that you're back to 300 bucks. You can see how the probabilities are changing. Here the probability of a win is said to be 20%. That's going to be a probability of making a penny by the time this is done. But the probability that sometime during the period of time when you're waiting for something to happen, if you just ask to try and liquidate, you can make a 50% profit with 50% of the time, because somewhere between now and then, UVXY will be between 11 and 21, and as it climbs higher, you'll be able, presumably, to cash out, maybe. And the ratio that you can win versus the ratio that you can lose influences the Kelly criteria greatly. So if we look at it that way, what we do is we plug in the new number, which says we only have a 20% chance of probability of profit, or 50% chance of half of the profit if we're willing to take the trade at any point between now and a year from now, which I think we would be. So now we're looking at 1684 versus 316 for two contracts. And we look at our return, the expected return 684, and the Kelly criteria says, yeah, you should put some more money into this. Go to 400 bucks if you want to, assuming you want to scale everything. And that's a vertical call spread on UVXY, which is going out 349 days. And you're buying, right? This is, you're buying something that's out of the money. So you're buying the 11 and you're selling the 21. So you're really, it's all premium. So you buy the 11, you sell the 21, and then that looks like a deal you might like to make, right? So you say, oh, well, let's throw, the maximum you can lose into the deal. So what I would do in a case like this, 316 bucks, let's take a flyer on it, do review and send the order, and you can see the positions I have in this already because I've been doing a number of spreads here. Some of them will expire worthless. Others will be something that you can presumably handle later. And then send the order in. And now we've got a whole series of different orders on UVXY, which allow us to scale into a position that may help us as insurance in case things should go wrong. Now, in the short run, what they show over in here looks quite normal. That looks like a normal distribution, only it's a bit skewed, and it's only 13 days. So when you're dealing with shorter time frames, the probability distribution function changes quite a bit, but that's normal. I mean, well, let's see, it's almost normal. And so now we can go and do this, again. This time we'll do a long call vertical, and we can see if we increase time, how much longer the tail gets on the right-hand side. Moreover, because we're pressing up against 0 in here, it's going to make it look more and more like an exponential distribution. Very Poisson-like, in my view. The question of what the parameters are of the Poisson model remains open. It's in fact a function of time, and you can see how it really peaks out over in here. I claim that it may be a less reliable model as you get further out in time, where here we are 496 days later. I gotta figure it's quite likely that UVXY is going to hit 9 and go past 14. The question of how the call spread reacts during that period of time, I don't know. One thing you could do is you could remove the upper leg, and then to reduce the upfront cost of the call, go out so that you are a little bit out of the money, then reduce your time. But look how much they're charging you for, well, I guess you might say for that insurance. Go out 1 standard deviation. Presumably that represents 68%, and that's what they're saying in here, that it's 1 standard deviation away from whatever this curve is. So here we are with a 68% chance, And he says my probability of profit's only 10%, but if I look at it, he says my probability of making 50% of my money sometime during the trade is 89%. But look at the max profit, it's infinity. So Kelly fails now, right? Because we don't know the amount we can win. You have to have a fixed amount you can win and a fixed amount you can lose in order for Kelly criteria to work. So if you really just want to take a flyer and go buy $142 worth of contract, that will give you a hedge as well. And in fact, the hedge is a rather unlimited upside. Normally, what I would do is try and constrain the amount you could win and the amount you could lose. So if you wanted to do it right, I don't know if it's right or wrong. I don't know what's right or wrong in this case. Go in time, watch the standard deviation spread out, and then sell one standard deviation away and buy one standard deviation closer. Now you're only 14 days away, and the amount you're spending is 16 bucks. The amount you can make is 384, but don't be fooled by that because your probability of making a profit is only 38%. So if you increase time a little bit, that will change quite a bit. See, it's gone up quite a bit just by increasing a little bit. What's going on here? Increase the time. We'll go out to one standard deviation away, 132 days. And no one knows what will happen 132 days from now. For all I know, there could be a forceful reunification between China and Taiwan, or Russia is going to get mad at OPEC, or who knows what will happen, right? Anything can happen. This is part of the reason why we have to hedge. So that will cost us 73 bucks, allow us to make $827 with a 51% profit, and 51% chance of making 50% profit. So if I plug that into the Kelly criteria, we get a whole other, profile to the deal, I'll say. So I'll put in, I don't know, what we call it, 51%. I want to be precise, I suppose, even though we have no idea as to the accuracy of these numbers. And so we'll just say, okay, the most I can win is $827. The most I can lose is the amount I put up front for the spread, which is $73. And this is looking very good. Kelly criteria likes it. It's a vertical call spread. It's on UVXY. And it says I'm going out 132 days. And now we want to do a buy of, and we're out of the money on both legs of this spread. We buy at 19, we sell at 28. So we buy at 19, we sell at 28. Now, if in the unhappy chance that this vertical call spread doesn't bear any fruit, we should be happy because it means our S&P 500 portfolio has probably been going up, which almost certainly means the Fed has continued to print money and made assets rather more attractive for us to buy. In any case, we take a $73 flyer on the spread, we review the order, send it in, and that's how you put up another spread. And I don't know if this analysis is correct. Maybe there's a flaw in it, and you can see it, and you'll tell me, and then I'll go and undo all of these things. Anyway, that's what I got for you in terms of my probability distribution function analysis. Talk to you later. Bye.